United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
All right. Service roll call, please.
Here. Here.
Here.
Here.
Vasquez. Rivas.
Here.
Diggs. Regnitz.
Yeah, here.
Laney.
Here.
Ritzy. Vine. Vasily.
Here.
Okay, 4 absent.
All right, well, we have a quorum, so let's start with approval of minutes. Approval of foundation minutes for January 30th, 2024.
I move for approval.
Second.
All those in favor signify by saying aye.
Aye.
Opposed, same sign. Motion carries. Got nothing under new business, unless there's something I don't know about. Okay, and then we'll move into the Capital Cities presentation with Amanda Black.
All right, good evening, everyone. Thank you for having me here today. As a reminder, my name is Amanda Black, and I'm with Capital Cities. We serve as an investment advisor to the Porter County Foundation and a co-fiduciary of the assets. So today, I'm going to cover a brief review of what was happening in the markets in the first quarter. I'll then cover performance in terms of how the Porter County Foundation portfolio performed, and then I'll give you a brief review of the portfolio construction study that we completed for you this quarter. So if you'll look at page 2 of the report, you'll see some charts just depicting what was broadly happening in the equity and fixed income markets during the first quarter. Similarly to what we saw in the fourth quarter of last year, we did see continued strong performance within equity markets. You can see those blue bars in the middle of the page were positive across the board for the quarter, so strong returns across all equity styles, and that's bringing us to strong double-digit returns within equity for the last 1-year period. Broadly speaking, even though all styles were positive, U.S. generally outperformed non-U.S. markets. Larger company stocks generally outperformed smaller company stocks. And then in a continued trend, we saw growth stocks, especially information technology sectors, outperforming value-oriented stocks. On the flip side, however, we did see more challenging markets within the fixed income area. On the bottom of the page there, you see different styles of bonds or fixed income, and we did see volatility. As you know, the Fed has been using tighter monetary policy to attempt to combat inflation. That has led to interest rate volatility, which has been challenging for bond returns. The Bloomberg Aggregate Index, which is a proxy for U.S. fixed income, was actually negative for the quarter. We've continued to see strong returns in cash, which has been a nice change of pace with the shape of the yield curve. And we saw some strong returns in riskier areas of the fixed income market, but most areas had negative returns for the quarter in terms of shorter and intermediate duration fixed income. With that said, you'll see in a second that your actual fixed income managers did perform better than the market, leading to some relative outperformance there. So let's go straight to your portfolio review, which is on page 6. So the Porter County portfolio is depicted here in terms of the underlying mutual funds that you hold there on the left. So you ended the quarter with a market value just over just shy of 185.2 million. Your asset allocation is depicted to the right there in terms of where you stood relative to your investment policy statement target. So the 55% equity, 45% fixed income and cash. And then at the bottom, you see a quick summary of performance, which I'll show you a little bit more detail in a second. The short story here, though, is that you had very strong returns for the quarter, bringing you to very strong returns for the year, not only on an absolute basis, but also on a relative basis. So for the quarter, your portfolio was up 5.5%, outpacing your passive benchmark, which was at 4.5%, so 100 basis points or 1% of outperformance. And then for the last 12 months, your portfolio was up 15.6% versus your benchmark at 14.6%. Also keep in mind that when this portfolio was first established, your static evaluation target was 5.0%. So this is not a normal year. It was a very strong year thanks to the strong equity markets. Let's look at page 9. Here we've got some more detail on your performance across different time periods. I already mentioned the quarter and the year, and I just wanted to show you the longer term number over there on the right where it says since inception. So since inception, this portfolio has had an average annual return of 6.62%, not only outpacing that 5% target, but also a passive target. So that means you've met your goals on an absolute basis, but also on a relative basis in terms of your actual underlying managers outperforming their passive indexes or benchmarks. On page 10, you can see some detail of market value movements, both in terms of deposits and withdrawals, as well as investment gain and loss. I point that out solely to show you that negative $5.6 million number there. That's the withdrawal that occurred at the end of January, beginning of February. So we use that cash flow to help organically rebalance the portfolio. And then finally, I want to show you page 11. I talked about that 6.6% average annual return since inception. This line chart shows you that exact same data on a cumulative basis. So since June of 2016, this portfolio has had a cumulative return of just shy of 67%, which the number there at the bottom there, that, what's the word I'm trying to say? The 67% corresponds to $84.7 million in investment gains in this portfolio over time. Pages 12 and 13 show you all of the underlying detail on how each of your different components of your portfolio has performed over the last quarter, year, and so on. Overall, what we saw is that equity was certainly the growth driver of the portfolio for the quarter and the year, and generally keeping pace with benchmarks within the equity segment. But your fixed income, while the returns were lower, is where you were really having a lot of outperformance relative to the broad market. So really strong story here. The way we look at that is when equities are up, you want to participate and be in line with that. And in areas where markets are more challenging, we want to see your managers do better than the broad markets, and that's exactly what we were seeing. So that's the review of performance. Any questions here before I move to the second segment, which is the portfolio construction study?
You said you took 5.6 million out. What, that go into our general fund, right?
Yes,
Okay.
That's the spending policy. That's the application of the policy to the rolling average of market values.
Okay, thank you.
Yep. All per policy.
Anybody else?
Okay, so in the second segment, this is something we help you with every year. Even when we're not recommending a change to your asset allocation or your mix between equity and fixed income, we do think it's very important that all of us as fiduciaries of these assets are looking at this and making sure that nothing has changed, making sure that we're all still comfortable with the objectives, the risk tolerance, and so on. So we've got some detail to show you. If you look at page 3, sorry, thank you. Page 3, what I'm going to do is just confirm the return objectives, the spending policy, the liquidity needs, the risk tolerance, and then I'm going to update you on some market inputs. I have some updated risk and return projections for broad capital markets, and I'll show you what that means for this portfolio. So on page 4, every year we have updated capital markets projections to show you. We get these from Callan Associates. These are not unlike what you'll see from other asset managers or consultants like Wells Fargo, JP Morgan, UBS, et cetera. So what we show here are what one might expect over a long-term period across different asset classes. So I would look at the second column of numbers where it says 10-year geometric return, because that's what we use to update your portfolio's risk and return expectations. So what you see there is that, for instance, broad U.S. equity, 7.65%. The way you can look at this is that looking ahead 10 years, it is reasonable to expect that broad U.S. equity should earn, on average, about 7.65%. That could mean 0% in 1 year, 15% in another year, but over a 10-year period, that's the projection. Fixed income has changed rather materially from last year when we showed you these numbers. Core U.S. fixed income now has an expected return of 5.25%. Last year, that was 4.25%. So these numbers are helpful in terms of modeling expected returns going forward. Now, we can't exactly predict what will happen, but this gives us a baseline from which to discuss sort of your exact objectives and risk tolerance. So on page 5, what we have here is just an excerpt from your investment policy statement talking about the Porter County spending policy. Just to remind you, and the reason we talk about the spending policy is because that's a key driver of your return objectives. We need to make sure that we're helping you put together an investment portfolio that is reasonably set up to help you provide that spending back to the county and also account for inflation. So that's why that number is so important. So that number is a 3.25% average or times an average of a 5-year kind of rolling number of quarterly market values. And that is consistent with Indiana code specific to this foundation. So because of the Indiana code that you must abide by, you do have an upper limit to 55% within equity. So a lot of other foundations out there will have 65% equity. So by design, this portfolio is a little bit more conservative, which means your risk tolerance is a little bit lower. At the same time, you're trying to hit that 3.25% mark plus account for inflation, and still have some left over for growth to the foundation over time. All of your investments are liquid and traditional. What I mean by that is you don't have any alternatives, no hedge funds, no real estate, no commodities, anything like that. You have stocks, bonds, and cash, and everything is liquid in terms of being in mutual fund vehicles that could be traded within 1 day. So going to page 6, we have just a summary of your asset allocation target. So you have plus or minus 5% bands around these numbers that you see here. So for instance, 55% equity, 45% fixed income and cash. The statutory code does give you a little leeway such that if you end up a little bit higher than that 55%, which is where we actually find ourselves right now, you have a certain amount of days that you can rebalance back to that 55%. You're a little bit higher because equities have done so well, so that's a positive thing. So you can see different styles of equity and fixed income are part of your asset allocation here. You have a majority of your equity is U.S., versus non-U.S. You have some passive equity, you have some active, and then you have several different styles of fixed income. Because fixed income is a really large part of your portfolio at 45%, it's really important to have different styles at work because of the challenging interest rate environment. So then on page 7, we can take those capital markets expectations that I showed you a second ago, and we can apply them to your specific asset allocation, your 55% equity, 45% fixed income, and we can come up with a general sort of expected return for your portfolio, and that number is 6.98. I know it's a little silly to take that out to 2 decimal places, so we'll just 7%. When we did this same exercise for you last year, that number was 6.4%. That's because fixed income expectations are higher because of the higher interest rate environment. So then just doing some really basic math, if we think about this portfolio being reasonably expected to earn 7%, we subtract out the 3.25% spending, a number for inflation, and what we see here is that on paper, this portfolio should have some real growth over time, which is very positive. The chart on the top right, we can run some analysis, using the software that we have, this optimization software. The part I'll show you is the probability line. So we ran a probability of what are the chances you'll earn a return greater than 5.75%. So the reason we chose 5.75, that's the 3.25% spending plus a bogey for inflation at 2.5%. And the probability is well over 50% across all those time periods that you will earn more than that, which means this portfolio should experience real growth. So the reason I'm saying all these things is that when you're stewards of assets that are not yours, your goal is to set up a portfolio so that it can meet your needs, but then have just enough, a little bit left over to grow over time without taking too much risk. So this is indicative of the desire to do that.
Where are you picking your inflation percentage from?
So that's also from Callan. So Callan Associates, they're the let's see that page. What page was that? Page 4. So they come up with all of the different return expectations across all the asset classes. They also estimate inflation. Right now, that number seems low. The last print, I think, was 3.4%. The Fed's target is closer to 2.5%. Callan believes that over the 10-year period, that is a reasonable number. But that's also, I think it's a good point that you raise, because when we look at that math on page 7, you could reasonably sort of put in your own inflation expectation there and see how that cuts into potential growth. On page 8, one of the things that we want to make sure that we're trying to do to the best of our ability and within the confines of the statutory code is to diversify this portfolio. In other words, not have all of our eggs in one basket. There's a lot on this page, but we can statistically measure the diversification of the portfolio. The short story here is that the expected standard deviation of this portfolio is just under 10%. It's that number on the far right. If you added up the individual contributions to risk of every sub-asset class, that's what all those bars are, the number would actually be closer to 12%. But because of diversification, the risk actually drops by that 1.94 percentage points. So we can statistically measure the benefit of diversification by combining different types of asset classes that are less correlated to each other. Something else that we did to sort of test the diversification of the portfolio is on page 9. So we took your portfolio as it stands today, the exact mix of equity versus fixed income, the exact mix of underlying managers that you have, and we tested it going backwards. And we wanted to test the up-down market capture. So I'll explain what that means first by looking at the second chart in the middle. So what we did here, there are 32 quarters of investment performance that we tested. We checked when your benchmark was down versus when it was up. So on the right, when your benchmark was down, that's when markets were down, your portfolio was slightly less. So slight protection on the downside. On the left, when your benchmark was up, your portfolio was up slightly more. So that's the right side of that equation that we'd want to be on. It might be easier to look at that at the top chart. It's the exact same data. The way you would read this is that you're capturing about 105% of the upmarket returns, but if you look at the x-axis, only about 95% of the down market. So you'd rather capture less down market, more up market. So again, that's the goal here. Participate when markets are strong, but really shine when markets are struggling. So on page 10, when we think about all of this together in terms of the quantitative data, but also the kind of knowledge of the risk tolerance of the county and so on, we feel like your portfolio is still set up very well to meet your spending needs without taking undue risk. We're not really hearing anything from you that would suggest differently, and we're not really seeing anything in the market that would suggest a need to make a change to the portfolio. We'll pause there for any questions or feedback.
Well, can we go back to the first tab? That's
Sure.
right, on page 7.
Sure.
Different colors and shapes going on now.
Yeah. The stoplight matrix.
Don't see any red in there, but there's definitely a box
Mm-hmm.
and some yellows. And that, I think it's the box, you know,
Well, that's right.
some red over 3 years. I don't know how you pronounce that. Wasak, ultra growth.
Mm-hmm.
I mean, it's a lost exception. Well, 3 years is what we have, but it seemed to perform better. But overall,
Do you want me to comment?
yes, please.
Sure. Yep, so on page 7, I didn't comment on this page because nothing on it is new from the last time I was here. With that said, absolutely want to kind of address what Jeremy is saying. So the Wasatch Ultra Growth Fund is the smallest holding in your whole portfolio. It is small cap growth, which is by nature going to be the riskiest area of the stock market that you're investing in. That is why, by design, the allocation is much lower at 3.4%. That fund has had extremely challenging performance. It is actually still negative since inception. Inception was right in the middle of COVID, October of 2020. That fund has struggled mightily. We put it on watch list status during that time period, technically in September of 23. And that's what that black box denotes, was watch list status. So we did a full review of the fund, and basically that fund, it tends to not invest in micro tech as much as its peers. And during the subsequent rebound from COVID, those were the stocks that rebounded the most, and that fund did not participate as much as its peers. With that said, over the last year, it was up 18.6%. So our goal with this fund is to try to determine if it's sticking to its knitting, if it's still performing its role in your portfolio, because the last thing we'd want to do is sell or recommend a sell at the bottom. So in our opinion, this fund was still doing what it had set out to do, and it was a very difficult market environment. We're still watching it very closely, but everything we've seen in the last 12 months has been very positive. We've not seen any significant outflows. We've not seen any departures from the portfolio management team. So we're trying to sit tight and have a long-term perspective to try to recoup some of those losses.
You say long-term perspective, exactly what time frame are you looking at?
So 4 to 6 quarters is what we put in the memo that we shared with you detailing this fund's performance. The reason for that is, market environments can be very difficult. And right now, if you're a stock manager who's not investing in the biggest IT names, you are absolutely trailing. But I'll get back to that in a second. So our goal is to make sure the wheels aren't falling off of the bus here with this fund, make sure that it's still doing what it's set out to do, and try to have a longer term perspective over 4 to 6 quarters where we're really trying to dig into the performance and see if there's improvement. Now, what I will tell you is you have a lot of passive management. So you absolutely have that exposure to those IT, information technology stocks. These are your active managers who are purposely in this portfolio to look different than the passive managers. So we do think there is a role for these active managers. It's just that they've underperformed when the passive indices have been up so much. So for instance, during this last 1 year time period, you have the S&P 500 index fund that was up 30%. So you are absolutely experiencing that. But like I said, we don't want to have all of our eggs in one basket. So we're marrying passive and active together, and it's a time period where active has trailed.
Do you have software where you can take a look at all of the holdings in all of the funds to make sure that you're not overexposed in any one name?
We do not have that software. That's part of the art to, the portfolio construction and the manager structure. It's part of the selection process. And so I know for a fact, going down these names, I could tell you which ones are underweight healthcare, which ones are overweight consumer staples. I could do that, but we don't monitor the individual holding level on a day in and day out basis. Okay. We look at it at the onset, and we sort of know the overall philosophy of the funds, but not on a sort of day-to-day basis. I can check with Corey, though. I think he was here last quarter.
Yeah.
He's more of our technology guru. So I'll make a note to see what we might have there. So I think if you look again at that page 7 and you read the comments, so much of the underperformance of these few names is because these managers have been weighted more heavily to things like consumer staples, financials, utilities, energy, in a time where information technology and consumer discretionary were at the top of the pack.
Is that a normal size list right there? To have a couple? I don't remember going back.
Well, there are 3 names on there. I would remind you that your overall portfolio is outperforming by 100 basis points for the quarter and for the year and the since inception period. So we're not trying to hit it out of of course we're trying to hit it out of the park. We don't realistically expect that that's going to happen with every single manager at all time periods. If it did, that would mean we don't have proper diversification. So there are going to be certain funds that have to lag if you're properly diversified.
Anything else with that? Okay.
Where was that one? Maybe it was in the back. I just know that you've talked, page 4, in the second tab, that one projection that comes out. Mm-hmm. That one, I just always, for as long as I've been dealing with funds, I'm always curious about real estate versus fixed income, that it always short-term, long-term outperforms, but few people they seem to always have more money in fixed income than they do like real estate. So I know we've talked about it a little bit, but
real estate?
Look at the alternatives down there.
Yeah. If
you look at the 10-year, what the projections are versus what some of these fixed incomes are,
Are you saying they're high or low, or?
Well, no, you get a better return in alternatives, right? In real estate, right?
Better returns in alternatives than fixed income?
Income.
That's definitely the expectation. We have plenty of clients who invest in alternatives, but when we presented it to this group, it hasn't been.
I'm just, bringing it back.
Yep.
Of, 10 of us, but
real estate has had very challenging performance lately. A lot of the broader U.S. funds have sizable allocations to office, which has been really dramatically impaired by the COVID situation and the flight from urban to rural and the flight from sort of in-person to remote. But long-term, I'm still a proponent of real estate and other alternatives if the risk tolerance is there and if the client can handle the operational complexity and added fees.
And it's not liquid, right? It's not.
Well, there are all different sorts that you can find. There are liquid alternatives, but then they have less of a return sort of premium. There's a spectrum.
I mean, what we'd be looking at is a real estate fund, right? So it would be liquid for us.
Not necessarily.
It would depend. I mean, there's everything from like a REIT mutual fund to a diversified real asset fund that's in a mutual fund vehicle to a commingled vehicle that has, quarterly liquidity to something with a private with a lockup.
Okay,
So there's a whole spectrum.
okay.
So just to bring you to date, I do have your current market value. It is just slightly higher than where we ended the quarter. So that number is $185,519,367. So we will be looking to rebalance soon to bring you back into line with that 55% target, which still is within you're following the rules, but we're closely keeping an eye on that. So year to date, so this is just calendar year to date, you are looking at a return thus far of 5.64%.
Did we finish with the portfolio construction review? Did anyone have any questions about that?
Okay? Bless you.
Let's go, please.
All right, well, thank you all. Anything else?
Is that it?
Positive.
Thank you.
Awesome.
Yep.
Yep.
Driving.
Okay,
Travels, guys.
thank you all.
Take care.
Okay, next on our agenda is the attorney's report. Do we have anything?
I do not.
Does anyone have anything for the attorney? Okay. And then we have the approval of claims. Capital Cities, second quarter, April 1st through June 30th, 2024, at $16,250. I'll entertain a motion.
Make a motion.
Second.
Got a motion and a second. All those in favor signify by saying aye.
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 All opposed, same sign. Motion carries. And then we have public comment. Is there anyone? All right. Before we stop, though, we should plan our next meeting. We always forget to do that. When is the council meeting in August, would it be? 25th. Or September. Probably September. Nobody wants to come here in August.
September is the 24th.
I'm good with that.
September 25th. Does that work for you, Barb?
RDC meeting.
Oh, what?
Yeah. RDC meeting at 4 o'clock, but we'll just have to be quick.
All right.
Make it, Barb.
We'll be in here, right?
But
We'll just kick you out.
yeah.
All right. September 25th. And we'll check with, I'm sorry, September 24th. And Joy, will you check with Capital City? Sure that works for them. All right, meeting adjourned. Thank you, everyone.
Thank you.
Definitely.
Thank you. What's that?
Shirley Gregory.
I'm not sniffing, I know that.
He sneezed. He's working its way down that one.
Please do.
Yeah.